Hi, Andrea. Welcome to this episode of Builders. How are you today?
Hi, Michele. Great to be here and feeling pretty good. Yeah, in a gloomy London weather, but feeling good nevertheless.
Great, great. So, first of all, I would like you to give us an introduction of who you are specifically and what 2100 is.
Yeah, sure. So who am I? An Italian, first of all, born and raised in Italy up until I was 18. Moved to the UK now 15 years ago, pretty much, actually in 2010. Initially building a company in the hardware space while I
Mhm.
was studying, and then sort of like went down the fintech path and the fintech rabbit hole. Spent around a few years working initially at Bloomberg and later at BlackRock
Mm.
and Goldman Sachs. So went through the full journey of working for like banks and sort of like asset managers and so on. And then from there, kind of like got dragged back into the startup world, joining a company at pre-seed phase, leading sort of like the product development from sort of like MVP to
Mhm.
full-fledged B2B SaaS, with which we went through essentially a big seed financing round. And then from
Mm.
there, sort of like went down the path of the acquisition from another player. But at that point, I sort of like didn't want to go back to corporate world. And so I did an MBA at LBS and started my journey in VC, initially in a fund called Connect Ventures, investing early
Mm.
stage across Europe. And then later at Atomico, spending a bit of time in fintech and infra before starting the journey with 2100.
That's very interesting. You basically did the entire journey from asset management to big financial group to startups until VC. So you have seen it all basically.
The zigzagging, as they
Yeah.
say, but it's kind of like, the way you actually sort of like build a bit of resilience around what's
Mm.
going on and different business models and different sort of like I would say game of incentives
Yeah.
in the financial markets. And I think, seeing it all is definitely kind of like a good way to build a
Mm.
diverse enough data set.
Yeah, I totally agree. I think that the old kind of model, having a traditional background and a vertical background, being in the same company for 15 years, is kind of old and dead a little bit. So I think that having transversal skill is like the new normal nowadays. But I would like to deep dive a little bit on your experience, on the last experience that you had, so launching a VC fund. So you don't always talk every day with people that actually did that personally. So I wanted to understand your experience about it. So how did it actually started? What's your investment thesis, and how did you actually raise your first fund? That is something that I think that many people out there are interested in.
Yeah, I mean, as I always say, I attribute a lot of value to luck, and for me, luck was, I think, came in the form of sort of
Mm.
like meeting people down the journey, and all
Mm.
started when I was at uni back in the days, where I met a friend who is now basically one of the partners at 2100, Andrea
Mm.
Casasco, as we call the second Andrea, or the third,
Mm.
depending how we see it, because it's three Andreas in the fund. And basically, we always sort of like got along around sort of like the world of VC. We spent a bit of time together, sort of like looking at sort of like how funds were built and so on and so forth. And we kind of like started iterating a bit on what would have been kind of like a fund to build essentially, but at
Mm.
the same time we were just kind of like brainstorming while we were having our own sort of like day jobs and so on. And the third kind of like bit of luck was meeting the third Andrea, which is basically the guy that I think kind of like connected the two of us again in terms of kind of like putting everything together. And the decision to build 2100 was kind of serendipitous in that basically we just met one day in London, and sort of like saw each other as kind of like complementary enough, which is something that definitely you need in this world, both in terms of like decision making and so on and so forth, and kind of like thought that this would have been like a great sort of like journey to together. And now I'm saying all of this as a kind of like a reflection bit, I would say. But at the beginning, of course, it wasn't exactly like that. The fundraising was I would say came very easy in that, and again that's the fourth bit of luck, to
Mm.
actually meet Alessandro Benetton, who is basically the main LP for this fund, and the
Mm.
kind of like initial kind of like promoter of this idea of building a VC fund with international kind of like exposure from day
Mm.
zero. Two out of three partners are here in London, and that helps a lot. That was one of the conditions. The decision to actually go for like 30 million of initial capital came as a mutual decision, and we were basically helped and supported by advisors that came onto the journey, specifically Luca Scani, Raffaele Terrone, and Stefano Bernardi, three people that again are very complementary, share the same type of international exposure, but a willingness to give back to the ecosystem. And so, as I said, it was basically a journey of luck and serendipity across all the different parties and a lot of hard work to actually get everything set up and started and so on and so forth. But this is kind of like how we actually came together.
And how much did it take in terms of time, contacting the LP, raising the funds, and everything else?
It was actually the opposite in that basically the decision was mainly to find the team to start the fund.
Okay.
And that was probably the biggest kind of like challenge, I would say, for the whole of the team. The capital and the commitment from Alessandro was sort of like decided together with him, and sort of like complemented by the other sort of like shareholders in this project and so on and so forth. But it's not your regular sort of like fundraising in that basically we were kind of like drafting the sort of like the idea based on what it would have been needed in order to be successful. And we can talk a lot about how emerging managers think about fund size and so on and so forth, but we saw the 30 million being a good sort of like number to start with. Generally, when I think about emerging managers, depending on the size of the or the investment team and so on, it's anywhere between 10 and 30 in Europe. And for us, we decided to be kind of like ambitious because we had the opportunity and the blessing for this type of size. And we went out and sort of like started with that. So not your regular fundraising. Still, it's something that we, and so for that, we're definitely grateful. But we know that, going forward, it won't be as easy. So, we see basically where that lands, of course.
Yeah, and I was asking that because recently, when I'm talking with VC managers and people that are launching their own funds, the usual or at least the average timing is between 1.5 and 2 years in order to raise a new fund. So that is a huge amount of time that you need to spend fundraising, and it's a huge effort. But I would like to focus a little bit on the size. You're stressing that topic a lot, and I think that is very, very important. In the last a conversation that I had in the last episode of this podcast, we've been talking with Ertan Khan, that is the founder of Multiple Capital, that is a fund of funds, and he was making the same exact point. You have basically right now kind of advantage having smaller funds compared to 100, 200, or 400 million funds. And basically, you can see about the kind of data and statistics in this market that smaller funds are kind of returning better returns over time. So I think that you are making more or less the same point. You're going in the same exact direction, basically.
So we spend a lot of time, even now that we are basically kind of like I would say sorted with the fundraising bit and full deployment mode and so on and so forth. But even now every 3-6 months we sit down and we basically iterate on one thing, which is portfolio construction. And for VCs, regardless if it's Europe or US, of course, with different sizes and magnitude of this, the portfolio construction is pretty important because it's a combination of it's basically your product, right? And myself, I was in product before. We have Andrea Casasco, who was before at Equation Capital, which is a fund of fund investing in emerging managers. So he's an expert in this case. And we spend a lot of time thinking about portfolio construction. Why is that? Because that is the product that we actually wrap and sell to LPs. But at the same time is what separates us from other kind of like emerging managers. Now, when it comes to portfolio construction, I think there's kind of like different ways to approach this, but we decided to do it so that we could basically maximize for different things, right? One is essentially investing in the funds that we wanted to. And of course, when you look into pre-seed and seed, which is where we kind of like focus our attention, there's a certain amount of ticket that you can command, right, with your kind of like investment, after which it's pretty tough to actually get into a deal. And especially when you move into the market that we see right now, which is very competitive for good deals, you got to be flexible enough. And that means decreasing your ticket if you need it, or kind of like making sure that you can command that ticket and then be kind of like living up to the promise that you make to the founder, right? So walking the talking, as they say. But so for us, basically the decision to raise that amount and staying within those sizes it was a journey of iteration. And even now, where we see ourselves investing around 60 to 70 deals with 5 to 10% reserves and so on and so forth, we keep on thinking if that is the right way and so on, because that affects also the way you think about decision making. That affects the way you stay relevant when you go out and pitch 2100 to founders. So there's a lot of iteration in that. But the good thing is we've now done around 30 investments. And we keep a close eye on a key metric for us, especially for a first-time manager, which is founder feedback. And what we see is that founder feedback, by keeping kind of like I would say, a high relevance when it comes to decision making and so on, pays off. And even if we're going to do 60 tickets at the end, so portfolio support becomes a bit tricky when it comes to scalability, you can still, by knowing in advance if that is a company that you want to invest for and that you can help, you know basically that you will be able to actually help them. So I think VC is a game of relevance, and it's a game of staying relevant as an investor throughout your deployment period and throughout basically the kind of like journey with the founders. And this is basically what we're maximizing for.
This is a very interesting concept, being relevant in this kind of industry. It's kind of hard out there, competing with the bigger name in the market, like Index or Sequoia or all the others, giant in this industry. So I was wondering, how do you actually do that, in terms of portfolio construction, but also in terms of the value that you can actually bring to those founders. So how do you actually do that? And second point, does it actually match with the kind of investment thesis that you have, because you need to balance the two of them. You need to be relevant and be consistent with your investment thesis, and at the same time trying to be proactive and bringing value to those kind of founders.
Yeah. So there's like any type of market, I think, naturally speaking, in order to be, in the top sort of like quartile, right? This is what we try sort of like to aim for. It's a lot of sort of like a journey of development for ourselves, and the kind of like inner journey of understanding what strength you have and accepting the ones that you don't have. And this is something that already separates, you'll be surprised, but that already separates a lot of VCs from the good VCs. So the first kind of like step for us was sort of like looking at ourselves as sort of like partners and managers, and understanding what we could bring and how we could quantify this as well, which is another key point, which is very tough. I'm a big proponent of network quantification, and I've been doing a lot of work on sort of like knowledge graphs and quantifications of network. But in my mind, that is the key point that you bring. So being able to understand the composition of your network and where you could be helpful to founder. I'll give you an example. The three of us, we don't share much of the network. Myself, I've been in the UK for most of my career. Actually, I never worked in Italy, so my network is largely skewed towards the UK. And my background in product and so on creates a network which is basically that of operators, people that have built stuff and so on, people that come from an engineering background and so on and so forth, because that's where my counterparties went throughout my career. For the second Andrea is more about the US, because he went to the US straight after uni and he developed a big network there across Harvard and a few other places. For the third Andrea, for Jenna, it's more about the consulting network. So having spent most of the time at BCG and in Italy, there's a lot of network there. So the three of us, first of all, spent a lot of time understanding the size of our network and how we could basically tap into different ones. And now we see when we invest into founders that are product people that we can easily A, source those deals, B, due diligence those deals, and C, help them by having sort of like knowledge of that, basically, or talking the same language that they speak. Now, this is one thing. So it's a lot of inner journey to understand what are you good at and maximizing for that. So when we talk to founders, we bring our sort of like network to the table and say, this is basically for you to tap into. And if we can help, we're going to help you. And so naturally, that brings us to helping a lot of international founders, either at pre-seed building the company, like I've done before, maybe, or expanding into Southern Europe as a go-to-market. So it's a company that maybe it's at seed stage and so on, sees the Southern Europe as a potential go-to-market and wants to have access to some of these kind of like players. We can go into them. So there's companies that want to have access to the industrial sort of like network in Italy. We can help with that. There's companies that want to have access to a certain type of like industry. We can help with that. The second thing is looking at your LP kind of like network and how you can kind of like synergically kind of like enable the personal network of the GPs plus the network of the LP. And this is where kind of like having the backing of industrial family, like the Benson family, helps us, because you can tap into a network of a holding of around 15
Yeah.
billion worth, 80 companies. And so there's a lot that we can sort of like do in terms of getting access to those kind of like companies and see how we can potentially create synergies and so on and so forth. And then, of course, the long-term play is kind of like enabling this at scale, which is tough, but we're already sort of like testing and proxying that with a smaller network to see how that could be done at scale. So it came out of a corporate strategy conversation with the three of us, and then the wider network, together with the advisors, to see how we could basically do this. Also to understand where to go from there, because another point that we haven't discussed, another dimension in this is there's a dimension of temporality, which is now, but how do emerging managers evolve?
Yeah.
This is another big question, right? So it's true that emerging managers have a natural kind of like tendency to start small for different reasons, and building a track record. But where do you go from there? It's basically a lot of the talking that goes on now with other kind of like peers, right? Because it's natural to say, now you have done 10, what do you do? You now do 30. Is the portfolio construction still kind of like working? And can you scale that? Can you scale portfolio support? How do you then manage now a portfolio of 30, 40, 50 companies, accounting for graduation rates and sort of like mortality of certain companies, but doing that at scale? So it's a lot of dimensions to be put together, but I think we have kind of like a strategy in place, which is what makes me kind of like what reassures me
Confident, I would
generally.
say.
You know what
Yeah.
I mean? Like it makes me help
Yeah.
sleep good at night, let's say.
Yeah. I would say it's very, very similar to actually building a SaaS product, to be honest, you know. You need to
Hmm.
start small, you need to put it on the market, and you need to try to understand where it will be when it's going to scale up, you know. So
Hmm.
it's kind of the same argument. So let's come a little bit back to the kind of investment thesis that you have. So we have been talking about on how to raise a fund, on how to on how to manage it over time with the kind of portfolio that you have, the kind of value that you can bring. But how do you actually choose those kind of companies? You know,
Hmm.
because it's one of the, if not the only, real metrics in this kind of industry. So you need to choose companies that are able to provide and give back value over time. So how do you actually choose them, and what's your actual investment thesis?
Yeah, we have a thesis that was a kind of like journey, and a thesis you will talk to a lot of managers that will say that it's your kind of like, I mean, we have sort of like, I'm a bit of a foodie, right? But when I cook,
Mm.
I use a lot of a type of flour, which is basically the live one. I don't know,
Mm.
how it's called, like, but it's basically one that keeps on sort of like, building and so on. So you use part of it and then it keeps on growing and so on and so forth, right? With yeast and so on. And it's pretty much the same with the thesis, in that basically you keep on developing it and shaping it, right?
Mm.
Around sort of like, a cornerstone strategy, right? So for us, what we saw at the beginning was a natural kind of like willingness to give back to the European ecosystem and willingness to
Mm.
invest in this European ecosystem for two reasons. One, we saw a natural kind of like growth. And to be honest with you, there's a lot of like talks ongoing now about the future of Europe and so on and so forth. We had I would say, the advantage of being always optimistic about Europe, having
Mm.
grown there. Sorry, yeah, having sort of like grown in Europe, and probably we're all in our 30s, right? And we were all born between 1990, 1991, 1992. So we grew up with kind of like no borders, right? It's a great thing because it helps you create a data set which is clean enough not to see what borders
What was
are
before?
sort of
Yeah.
like doing, right? So
Yeah.
we grew up in a very connected ecosystem, although we realized that there's a lot of like challenges there. So the first
Mm.
thing that we saw was we need to be bullish on Europe, and we need to kind
Mm.
of like build around that. So what we started to think about was what will be the kind of like what will be the drivers of
Mm.
innovation in Europe, and how are those drivers talking to our kind of like background. So on one hand, and again, it's very kind of like speaking to the true nature of who we are individually, and then kind of like making sort of like this kind of like talk with a wider ecosystem. For me, it's always been about product and building stuff. And it's
Mm-hmm.
always been about kind of like going behind the face of things. Maybe as a product guy, I've always been kind of like trained to actually go and talk to engineers and understanding back end before going into front end. And so
Mm.
for me, it's the full stack that creates kind of like value in this. For the second Andrea, it's always been moving from the lawyer background that he has into the more regulatory background and
Mm.
naturally being drawn by green tech and climate tech. And so he basically started his own kind of like journey of understanding and growing his knowledge and so on in this space. And now he focuses on that. For the third Andrea, it's always been the world of kind of like consulting and strategy
Mm-hmm.
and understanding how a corporate is built and how it operates to then see what kind of like gains could be done at all levels. And so naturally vertical SaaS and all the things that can actually help there.
Yeah.
So we have an umbrella thesis that speaks about what we call the golden age of industrial innovation or the sustainable industrial revolution in Europe, which is a concept that is ongoing and so on and so forth. It's a thesis that speaks to businesses, which is basically what we also speak to when we actually interact with the LP network and personal network coming from our background. And so it's a B2B thesis around Europe, so European founders, and it speaks around three core areas. One, which is the digitization of the old economy, so more on the corporate level.
Mm-hmm.
The second one speaks about what we call essentially it's decarbonization and everything that speaks about green tech and climate tech. So there's a lot of hardware, there's a lot of new components to do things and so on and so forth. And my thesis, I'll be spending a bit of time here because it applies also to fintech as well. I call it the new units of value. And
Mm-hmm.
essentially what it speaks about is in my career over the last 10 years, I've seen value of tools shifting from different layers, right? And
Mm.
I came to, and I keep going back to reading books about physics and first principles. And first principle speaks about creating building blocks of things and see things bottom up in order to build essentially value. So every time I look at a product or at a company, I go back to the atomic bit of value that generates the highest amount of value for a single product. The new units of value is essentially saying when I started my career in product, the biggest unit of value was very close to the user.
Mm.
It was basically the age where open banking was not there. It was basically the ages where essentially everything was built for a final user. There was a lot of focus on UI, UX, and so on and so forth, product-led growth. So using the interface to actually create value in the organization and disseminating that value across the organization.
Mm.
Then over time, I started to see more and more until now, essentially, which is probably the biggest kind of like moment in time where complexity and technology is actually behind the scenes. I've seen the shifting of this value from that application layer into downstream layers. In fintech, that was open banking, that then became the biggest value generator of the fintech space. In other areas like cloud computing and so on, was essentially data being stored
Yeah.
in the backend and the rise of data being organized and sort of like infrastructurally speaking, building all that layer. And this is where now I'm spending most of my time investing. So we've done investment in cloud computing. In the age of AI, that is naturally kind of like the biggest source of value. So everything that is data, AI, cloud computing, in fintech, it's basically everything that is pure kind of like infra and so on. So yeah, these are kind of like three core areas, and for me, that is where I'm spending most of my time.
Yeah, yeah. I would love to go back later on talking about the fintech thesis because it's obviously my main area of expertise. So I think that we can discuss it a long time. But first of all, I think that we absolutely share the passion for physics. So I love the concept of atomic rational, and I have a couple of books that are actually stressing that out a lot. But before to move on, I wanted to stress one of the topic that you just actually said. So one of the main concept of your investment thesis is actually focusing on Europe and actually investing on European founders. So I think that we are in a period of time where this kind of investment thesis is kind of hard to sustain in a positive way, let's say, because we are lagging a little bit behind other kind of markets. Of course, the US is miles ahead, but also Southeast Asia, it's kind of another level. We saw basically many different kind of new environment raising up Latin America is very interesting. The MENA region is coming. Africa overall is very, very interesting. So there's needs of positivity and hope in the European ecosystem overall. But we still miss those kind of founders. We still miss the kind of mentality. We still miss the kind of ambition that founders have. So I would like to understand your point of view on this one, because we absolutely need someone that is investing in Europe and have that kind of mentality. But we still don't have, in my opinion, the same kind of ecosystem and the same kind of market.
I'm a bit like on this. I think there's a lot of tendency to kind of like focus a bit too much on the noise rather than actually sort of like looking at this from a bit of a more holistic perspective. I think Europe has done a lot of progress over the last years, and I think it goes back to like all of this conversation goes back to mindset. And mindset means that when I want to invest in European founders, I look for European mindset, right? I don't look for founders that are based in Europe. I don't look for founders that are sort of like that have a specific nationality. I look for founders that have a mindset which is the same one that I grew up with, right? And I don't think from that perspective you have an issue with European founders at all. What I mean by this is, so I want to split this, but European, so it goes back to culture, I think. And there's a certain thing where the Americans or the US investors or the US kind of like founders built on top of a track record of success, which is what I think allows anybody to express his opinion, misses the point of the value of keeping your true kind of like culture and core aspect in building things. Now, what it's still missing for European founders, and I think that is happening because it's a natural kind of like sort of like evolution, I think, of the ecosystem, is contamination. So what I mean by that is the best founders that we actually work with are the founders that have been contaminated by different type of approaches to building companies.
Oh, that's very interesting. But when you say contamination, you mean from other European countries or also from outside the EU?
From outside the EU, for sure. And this is why sometimes we've done a few deals in Europe, in American founders building companies in Europe. Why? Because we saw cultural arbitrage being a great thing as part of the portfolio to actually build in Europe by being American. Because you come in with a bulldozing mentality, that is what really sometimes help you succeed. Now, founders that we also have in the portfolio that have been spending a lot of time in the US and now they're coming back to Europe to build things have exactly the same type of mentality, which you learn by being exposed to a certain culture, but you do it in your kind of like ecosystem that you know, which is Europe. So you are a European founder by mentality because you've been grown and you've been educated with a classical culture, the culture that has been kind of like driving, European kind of like growth over the last 300, 400 years, but you also are exposed to what is the American mentality, the American mindset. And that could be also, exactly like you're saying, right? The guy who spends time in Middle East and is now kind of like building his own thing in Europe, or the guy who spent time in Asia. And then those kind of mixes, I think, are the ones who make great founders. I'll give you an example. There's a lot, we spend a lot of time looking at the Italian diaspora. So because it speaks a lot to our values, having been sort of like founders and sort of like Italians, spending time abroad, but it's also a community that we really want to kind of like build. These people are the perfect example of contamination. They grew up maybe in Italy. They've done maybe high school there. Then they went to the US, the UK, or anywhere. They've been contaminated by different cultures, right? Which, for good or for bad, if you're a good sort of like evaluator of values, are just growing your kind of like overall mindset and so on.
Knowledge. Yeah, absolutely.
Exactly. And then you go and build your thing. And we don't care where you are, honestly. Like, of course, if you want to go back to Europe, we're going to sort of like help with that and so on. But you see that there's a lot more value. And by the way, this is not a European conversation, like a US founder who spent time in Europe and has looked at, the beauty of Florence and so on, will know how to build beauty in a product that has
Yeah.
been built for a US audience. So I'm always thinking about, I'm a big proponent of this, but it's multidisciplinary exposure to
Hmm.
different sort of like interest and asset classes, right? Cultural
Hmm.
asset classes. It helps. And so that is why I think Europe has an advantage because it's built on solid foundation, history, right? And then sees other models and can be emulating them.
Hmm.
So not just imitating, but emulating. Imitating doesn't work. Imitating only works if you are like a Rocket Internet or plays that makes perfect imitation into
Yeah.
markets. That's great. I see sometimes this, like Italian founders in Italy doing exactly the same mistake, imitating other models and trying to make them fit into a different cultural model.
Into different
That
cultures.
doesn't work. And
Yeah.
that's why I love fintech,
Absolutely.
because fintech is
Yeah.
global. You
Yeah.
can't really imitate in fintech. You
No, you
only
need to
build for a
innovate.
global audience, right?
Yeah.
So
Because
you don't build
if
value
you're
out
gonna
of
build another
imitation.
visa, there's already one. So
Doesn't work.
yeah, yeah,
There's only emulation as a
yeah.
as a way to go.
Yeah, no, I strongly agree on this point, to be honest. I think that the kind of cultural mix and the kind of contamination that you're talking about is really a huge advantage. And I also believe that it's not working only in one direction, not just having people from Europe, being contaminated by the US or by India, by China, whatever it is, but also on the opposite way, because having that
Mhm.
kind of mix, it also match with the things that we were discussing in the beginning, having the kind of transversal skills and transversal experience. It's, in my opinion, the new normal. You cannot
Mhm.
just stay in the same place with the same kind of skills over time because it just doesn't work anymore.
Yeah, but it's
And
happening.
yeah,
By the way, if you look at the
yeah.
stats, it's not just, the good example is France that
Mm,
had a policy around AI to sort of
yeah,
like bring people back from the Valley and so on to the Bay Area back into Paris and giving them an ecosystem.
yeah.
And you see what happened there. We see
With
a lot
Station
of,
F
yeah,
and
exactly.
everything else. Yeah,
A few months ago, we hosted an event for applicants to YC,
yeah.
European applicants. We've hosted it in Milan, but there were a lot of people that came over essentially. And I mean, you see the numbers now growing of European founders going to YC. We had the first one, which is Stefano Bernardi, which is one of our
Hmm.
advisors. He's the perfect example. He's one of the people I admire a lot because he was the one who knows about the culture in Europe. He basically went to the Bay Area when nobody knew in Europe what was YC, what YC. And if you look at him and the way he thinks, you would not say he's Italian. It's just like a perfect kind of like
Mix
encompassing
of
of
everything.
all of
Yeah,
these values right
yeah.
together. And that what makes a great GP, what makes a great founder. He could do whatever. So
Absolutely. No, totally with you on this line. Absolutely, yes. I would like to deep dive a little bit more on one of the topic that you were mentioning about fintech, So my main area of expertise is fintech, and I'm very, very vertical in that sector. I would like to have your take on the kind of future of this industry, So you have a specific vertical in your fund about this industry, and you are very focused on that. I think that we just came out of two of the worst years maybe that there were in this industry overall, and it was very, very tough for many companies out there. It was very tough for many startups, many layoffs, and everything else. I think that we are kind of at the bottom of that kind of trend, and we are seeing right now the indicators that we are going up again. I would like to have your take on 2025 for fintech and maybe also over the next 5 years for this kind of industry. What do you think is going to happen? And if you are looking at some specific trends in this industry.
mhm. um, the whenever I think about trends and so on, I think I always try to sort of like listen and talk to people that have had at least a few cycles
Hmm.
in terms of markets in order to
Yeah.
actually understand fintech, because I think the data set otherwise is a bit kind of like too small in order to understand that. So the first thing I would say is fintech in particular, given that it's tied to financial markets, lives out of a natural cyclicality. And the
Hmm.
first thing that investors need to understand about this, of course, I mean, I think most of them do, but the ones who invest in fintech need to understand that it's a natural process that affects like from the external bit, a lot of business models, right?
Yeah.
So when I started in fintech, and when I was basically sort of like studying, it was 2010 and 2012 and so on, the whole world of fintech was in a mess, essentially. There was a lot of growth, but interest rates and the whole financial crisis and so on was affecting a lot of that. And it came a resurgence out of that. So 2008, 2012, Europe was a bit sort of like struggling there to say in a nice way, but low interest rates environment built certain business models, right? And people started to assume that that was the norm. And then all of those business models, see Revolut and so on, there were winners out of that. There were many of them, right? But there were businesses that were basically focusing on top line revenues, and money was free. This is the first thing
Yeah.
that people need to understand, that when money is free, there's a different type of approach towards financial markets that has different implications that go direct to startups, but also to the sort of like indirectly speaking to investors and so on. So natural exuberance and so on. So the first trend that I saw going a bit back into the past was the transition from low interest rates to high interest rates. Certain type of models would not exist unless they were in low interest rates. And this is
Yeah.
what drove a lot of the mortality of certain startups to not understanding that the business model was only tied to a specific rate environment. So that was one thing. The second thing was essentially kind of like a natural, I think, fatigue in fintech over the last few years in terms of understanding what and how the fintech landscape was changing. I think we got to a point, and I got to be honest, I went through this kind of like psychological challenge over the last few years where I could not invest in fintech because I could not find models that were somewhat resilient to the bigger data set that I had in mind, which was low interest rates, high interest rates, certain type of products over others. And there were not incredible innovations that led sort of like new models to be built. There were geographic winners, you know,
Yeah.
you look at
Regional
the south of the,
champions.
yeah, regional champions out of the world. There were a lot of that. There was a lot of consolidation as well happening. And
Yeah.
probably the winner of the last few years in terms of models were the bundling models. We've done an investment in Swap, which is part of the portfolio that we have. Incredible founders. It's a bundling model that has a fintech component at its core, which is the usage
Yeah.
of data, and a bundled solution like an all-in-one OS for e-commerce. That was a bundling model that when I saw it, I was like, this is a winning one because it builds everything around the focus on essentially optimization. So one thing that I will say is I'm seeing more and more that the models that will be winning over the next few years will be around optimization. And AI, on that perspective, is basically the biggest driver of optimization of processes. So now you have two things, essentially, a transformational journey in fintech, plus I think a generational kind of like a moment with AI applied to a market like fintech that will naturally drive the resurgence of this sector.
Yeah.
On top of that, I've seen blockchain and tokenization and all of that world kind of like falling, rising and falling, basically. Models like, aside from tokenization, but an example of low interest rate things were Robinhood. We saw free trade last
Absolutely.
week.
Yes.
So these kind of things are low interest rate businesses that naturally sort of like don't scale in certain kind of like areas. With tokenization and so on and so forth, now we're seeing institutional adoption. And I was working in sort of like a tokenization play, and it was just not happening. There were POCs and so on. It's a longer sales life cycle and so on. So now
Yeah.
we're at a stage in which that will be naturally happening. And again, we found the use case and the killer app in stablecoins, and that will just naturally happen. So why? Not because it's such a transformational bit, but because it optimizes the journey.
Yeah.
It's now a moment in which the fintech businesses need to be built not on top of top line revenues, but on top of margin optimization. This is what's happening, right? You look at interchange and the kind of like pressure that goes on Swift and Visa and so on and so forth in order to reshift the dynamics. And we've been always talking about that. But now you have use cases that can really help. And stablecoin is a perfect example of this. So
Yeah,
you
I think
see that
is one of the
it,
most interesting trends right now, to be honest. Is one of my
it's
top
amazing.
prediction for 2025 in terms of
Yeah,
payments, of course.
it's because now you see institutional adoption. You see
Yeah.
Nubank, you see the Stripe of Source, you see
Hmm.
Bridge, you see kind of like, and those are transformational moments because now it's the moment in which those kind of things are, and they have kind of like a path towards being included and being integrated as part of the journey. And again, this is something that operators understand. The public doesn't need to understand too much about this. This is
Hmm.
another thing that it's also cultural kind of like shift, right?
Absolutely,
Fintech,
yes.
etc., doesn't have to be something that the final users see. The final user needs to benefit from this.
Yeah.
Lower fees, all these kind of things will be drivers of adoption from a consumer perspective. But
Hmm.
it will have to be done at infrastructural level, which is tough and so on and so forth. So that's one thing. So stable coins for me, it's basically something that I'd love to make an investment this year. I think it will just happen, and I think it's yet to see who the winner will be. But we need to also see what regulation will be kind of like driving around all of this. So it's kind of like a wait and see moment, but there's a lot of models that are out there
Yeah.
and will naturally be winning out of this. We saw a lot of interest in A2A over the last few
Mm.
years, especially last year. I think it's naturally kind of like going to happen as well. Different type of models and so on and so forth. But I think we're now in kind of like a stage in which there is wider adoption in all of this. Open banking will definitely kind of like be there to support this. Um, and this is great to see because again, it's another thing that benefits final users,
Yeah.
but it creates new kind of like wave of innovation in the space. All in all, I think it's going to be about optimization. That's
Mm.
again something I really want to stress. So I'm always looking for kind of like plays that focus on this kind of like virtuous margin play, essentially.
Hmm.
Smarter payments is another thing. So we had A2A, so we're talking about faster payments, which is a great thing. How about we bring optimization towards this? So how
Hmm.
about we actually bring payments and ways to pay and so on, which if we go back to 2019, 2018 was about giving more choice. But as we know, more choice creates more unsatisfaction in the final
Yeah.
user. So lack of adoption. And basically you now need something that optimizes them. So again, another thing where the primer of source or orchestration layers brought optimization at business level and they brought an additional layer, which is great. Now we need to basically bring this to the wider public. So these are other things where, I see
Mm.
kind of like a lot of value. And then leaving aside the consumer, which is not my core focus, but I'm still kind of like waiting to see the big kind of like personal finance management app that will go and sort of
So,
like manage that. But those will be models that will be driven initially by businesses
mm.
that will then trickle down towards consumer. I
Yeah.
naturally see that, and we are already seeing. We've recently done an investment into a company that is working on agents for buy side to actually
Mm.
help optimizing margins and help optimizing the flow of what is essentially the creation of the management fee into buy side. So highly
Mm.
competitive environment and so on and so forth. When those use cases are unlocked and people see that there's value in there, naturally we'll see other areas being affected by this in a more kind of like effective way, I think.
Yeah, no, I think there are many interesting topics on what you just said. Most of all, I believe that 2025 will be the year of stablecoins. I see many different use cases. I see the kind of optimization they can make and everything else. On top of that, I think that one of the clear loser of the last couple of years was, for example, banking as a service. We saw many different companies recently struggling a lot. And I think that we are in one of those specific moments in time when a business model is seeing that it is dying and it needs to evolve and change into something else in order to survive. And I think that this could be the year for banking as a service in order to have something new based on the same kind of concept, and
Yeah.
optimization could actually be the case there because those kind of business models are very, very expensive, capital intensive, a lot of people working on it. And you can actually have a lot of optimization, bringing prices down and actually having a new model about it. So I think this
Hmm.
could be one of the things that we can see. While you were
Can I say
talking, I
one
was.
thing on this?
Mhm.
My call to founders on this basically is to be smart in understanding how the current processes are built and how scalable they are. It's
Yeah.
something that in fintech has always been kind of like difficult to do because each bank
Hmm.
has a different way of doing things and so on and so forth.
Yeah.
But focus on models that are scalable and see pathways and sort of like do a lot of work in understanding how the current system works and find patterns in them. Seems like an obvious thing, but it's difficult to find founders in fintech that, and when you find them, you really have very good conversations that have the technical understanding of how current processes are built from an abstraction
Yeah.
level. And this is something that, I've had the pleasure to meet a few founders last week, last week and last year that shared that understanding of
Yeah.
basically that solution. I had, some of them I
It's
managed to
critical. Yeah, it's highly critical to try to understand it because if you take a look at from the outside, everything seems pretty clear. No, let me give you
manage.
one example here. One of the biggest conversion killer in the digital banking industry is obviously the KYC. You need to identify your customer in order to open a bank account for him. And when PSD2 came out, everyone says, okay, now we have the same rule for every country in Europe, so KYC is going to be easier, going forward. And then you actually take in consideration if you work in the industry, that is not actually the case because PSD2 actually set up the minimum level of the requirement for the KYC, but it doesn't put the level from the maximum output. Every single country need to have the same exact information, but they can ask more information on top. So you have a different KYC in Spain, a different KYC in Italy, different KYC in Germany, and no one actually find out a better way to actually do that. And it's kind of counterintuitive, and it's kind of the opposite of what you want in terms of innovation. But you need to work in the industry before to understand all of those kind of things.
Yeah.
And you have the same exact path in open banking. Every banks out there is asking and giving different kind of information with the same set of rules from PSD2, and it's actually crazy if you think about it. And it's actually hard to scale them up,
Yeah, yeah,
but
and
it's
integrate
very
them
very
as well.
interesting. Yeah, absolutely, yes. But I think that is very very interesting. I think that we are in that kind of moment in time where you can actually drive a lot of growth in these kind of areas. There are a lot of innovation happening, and a lot of new things that are going on at the same time in this kind of industry. We have been talking about digital banking. We have been talking about payments. Open banking, in my opinion, is going to be one of the new winner in the upcoming years because it actually went through that kind of shift in mentality and in business model and everything else. And now we can see the real use cases in open banking and embedded finance, and we can actually see the output. Unfortunately, I still didn't saw a good solution for PFM, to be honest. I think that this is
That's
one
why
of the
we manage
topics
our
that
finances so bad
no,
because we
it's
still
crazy.
like
I
lack
mean, we have
the.
been talking about this topic since I think 2012, and I never saw a single business model, a successful business model on PFM.
Mhm.
I still need to see something like that. It's
It's
crazy.
crazy. This is why it's. I mean, because one of the reasons I think is the underestimation of the complexity around managing data and integrating data.
Hmm.
I think it's basically now with AI, basically what you need is good data to feed a model.
Hmm.
You can always write the model, you can always apply on top sort of like ontologies, but essentially with prompt engineering, like it's not from a product perspective, it's not incredibly difficult to build the second bit. So the retrieval and so on
Hmm.
of
Yeah.
those kind of like of the data. Yet the data ingestion and the scalability of this is not there. Like open banking has helped, but it helps until a certain point, right? It helps until the current account with
Yeah.
PSD2 and so on. And then you need basically to have other accounts being linked and then finding that in a very manual. So it's basically the first obstacle that needs to be kind of like managed in order to drive adoption. The market is begging for a winner. I tried
Absolutely, yes.
15 tools over the last years in PFM to see which one literally as a sort of like as a user, not as an investor,
Hmm.
but to see how that would play out. And all of them failed in terms of like
Yeah.
making sure that I would not churn in 2 months, 3 months max
Yeah.
because of the amount. It's a bit like tracking food. You know what I mean? Like there was one winner,
Hmm.
which was MyFitnessPal or others. Like I don't know, but I'm using that a lot. Why? Because you can scan a barcode and put all the nutritional values into sort of like the app.
Yeah.
It's such an easy one that it creates a frictionless kind of like
Yeah.
experience. But you need kind of like a sharing of the data from barcode. So you need entity resolution. You need a lot of that first, and you can't use community-driven adoption
No.
like a fitness app where somebody uploads that and then it goes into the wider space. So it will naturally happen. We just need a bit of time and more data, I think, to be disseminated with some sort of like standards and so on. The winners were the ones who, like open banking, created Rosetta Stone to actually sort of like, manage that. So
Match everything basically. Yeah.
yeah, but there's a lot
Yeah.
more to be done there. So
Absolutely, yes. Yeah. So, my last question for you, we've been talking about the verticals, we've been talking about the markets, the founders and everything. I want to, as a GP of a fund, I want to understand which is the main characteristic or main, variable that you are looking for in a founder to actually invest on him. So, what are you looking for when you are, speaking with a person that's just launched an idea, and why do you invest on him?
um, I it's a good question. Um, there's for sure a kind of like an understanding of, well, the key thing that it's a non-negotiable for me is meeting a founder that knows how to build experiments.
Oh,
So
that's interesting.
the non-negotiable, so every time I look at a founder that knows the basics of how to build an experiment is what I'm looking for. Well, the reason is that is a proxy of different things: decision making, conviction building, and ability to know what exactly you're looking for in your business and in life in general. That's why I end up investing a lot in operators, product people, and so on and so forth, because we were trained to build experiments and to test them, right, and see if we were right or wrong. That means you have a null hypothesis and what you're trying to test, right? So you know that there is a high chance that there is an hypothesis that can be proven wrong, and you have to adapt to this. When you're a pre-seed, you're doing an experiment. You're like in
Yeah.
a lab. So you have to be very nimble and very kind of like flexible with your mindset to tailor this according to what the data shows. And then you apply on top your models and how much exposed you are to different things, which is the second thing that I look for. So the first one is ability to build experiments, and the second one is multidisciplinary knowledge. So having people that have been doing different things exactly like I've done, but it's not like a bias that I have. It's simply that I see the value in doing all of this that help them draw from different experiences. And this is the two things combined together. One gives you a solid understanding of data for decision making, an ability to basically change your mind according to what the market shows. And the second one is basically bringing intuition to all of this and essentially saying, why don't we take something that works in other models, or why don't we take something that works in other discipline into all of this? And those two things together so far is for me the sort of like the bit of
Best
alchemy
mix.
that
Yeah.
creates essentially something new.
Yeah.
So I don't know if that is the answer that
No, I mean,
you're looking for, but
coming from a product and financial background, I strongly feel that because for a great part of my career, I needed to test things where I didn't have any visibility or data or something. So you need to find a way. That's just it. You don't have a playbook. You need to find a way to actually test things and validate assumption, and it's way, way harder than it seems. So I absolutely feel that. Just in order for you, as a feedback for you, many multiple times in the past, one of the most common answer to this question was, I want people that are obsessed with winning. That is also a nice answer, but I really like, coming from the same background, I think I really like your answer most. So yeah. Thank you very much, Andrea. It was a wonderful conversation. We could have going on, talking about fintech for I think another couple of hours at least.
yeah,
But
easily.
we need to stop it there. So thank you very much for joining again, and I wish you all the best for your upcoming
Real
future.
pleasure, Michele. Thanks, and a big fan of the newsletter. So
Thank you
read the
very much.
newsletter. It's great.
Thank you, Andrea.
Thank
Bye.
you. Bye
Thank
bye.
you.